trading out of drawdowns. How do you do it? What sort of approach do you have? And how do you get back in sync with the markets? Hi, it's Charlie giving you Wednesday's video. I hope you're very well. This question actually, the title of this video actually came from a question here that I had on the YouTube channel just last week from one of the other videos last week. And last week's video, this person's had really rough days. How can we get through rough times was the question. Okay, so I said, look, I'll do a video on this. So this may not be per se about drawdowns, but this individual's obviously just had a bit of a rough week. But I thought I would cover off a number of factors here. Yes, the drawdown or trading out of a rough week, but also trading out drawdowns, and also a lot of the time when you're having rough days. So this is obviously someone who does a lot of short-term trading. Sometimes you can just feel completely out of sync with the market. You think you're taking your trades, you're taking your trade setups, but they just don't work, and it just feels like, oh God, nothing's working. So you feel completely out of sync. So we're going to cover that one off as well. So firstly, let's talk about trading through these sort of rough periods here, and less so about the drawdown, but how do you deal initially about, in this person's instance, we're talking about rough days, but it could be rough weeks. It could even be, if you're a swing trader, it could be a couple of rough months, because when you're a swing trader, markets can get sticky for a month or two, and so you've got to, or longer potentially, so you've got to trade through that as well. So it applies to all classes of trader here. I think firstly, a little trick is to take a step back. The easiest thing you can do is take a step back. It always allows you to get a perspective. So if you had as a short-term day trader like this chap, if you just take a couple of days off, it is amazing just what taking 1 or 2 days off can do for you. Even the weekend itself can quite often act as a good reset for you. But I always found historically that actually taking a day off when the markets are open is a really good thing. So probably the first trick to do, take a couple of days off or so, because it allows you to reset. It's amazing when you come back to trading after just a few days off, how you just settle down. The problem that a lot of traders have is that they don't, and so they just want to go into the following day and I'm going to make it back the following day, or and they have that sort of attitude, and so at that point you're still very much condensed into that mindset of, oh, I've got to make this money back. The longer you take, if you have a little bit of a break, just a few days, is often all it takes. You sort of settle into it a little bit, and you've accepted the losses and the sticky trading that you've had, and you're better mentally prepared then going forwards. So that would be the first thing that I would always suggest. The markets aren't going anywhere. So, and anyone who says, oh yeah, but if you've got a mechanical based strategy, then you might miss out on the winners. Yes, you may well do. But as I always say with trading is all mindset. And so if it doesn't matter if those trades are, if you're missing trades for a day or two, it really, in the grand scheme of things, no, it doesn't really matter, because if you could look at it that way, but you can also look at it and say, well, yeah, okay, well, you could go straight back into the market the following day. You've still got all that tension and anxiety and whatever other emotions you may be having. So you still may not trade well, even if you get some half decent setups. So you're better off just disconnecting for a little bit. That's always the best thing, rather than thinking, oh yes, but I'll miss out on the next trade. Oh, come on, it's not that important in the grand scheme of things. Not if you're doing that sort of short-term trading. It's not like you're going to go and miss a 1-to-50 risk-to-reward ratio trade. That's not going to happen. The next thing, if you're in what this person said, trading through rough times, it might be that the markets you're trading are chopping around. So this person's obviously a short-term trader, intraday trader by looks of things. So just put it into perspective. Take that step back, put it into perspective, and just know that the market isn't going to stay like that forever. But at the same time, it might be like that for another week or whatever. So again, just desensitize the situation. And if you look at the big picture over a period of 12 months, and if you look at any chart, in fact, over a period of 12 months, you're probably going to find plenty of chop or periods where markets are consolidating over that period, whereby, for an intraday trader or even for a swing trader, there's going to be chop, there's going to be market price action which doesn't suit your approach. So we have to accept that there are going to be times like that, but if we can put that into perspective and just picture yourself in 12 months time looking back at where you are right now saying, oh yeah, it was a flash in the pan, really. Yes, it was just one of those little periods that challenged me, and actually I've grown as a trader because I can bank that as an experience. So the best thing that overall you can do in order to trade through the rough periods, how can we get trade through rough times, is yes, initially if you're feeling it, take a couple of days off. After that, I would say you've got to accept that there's going to be periods which are not as fortuitous for you, but you'll come through it. Picture yourself 12 months down the line, two years into the future, saying, oh yeah, I've had plenty of those, but I've also had plenty of good periods as well. And it's just the way these things work themselves out. It's always going to happen. It happens to every trader. And then you have to trade through it because you may say, okay, I've taken I feel so much better after a weekend. Right, I'm ready to go off and trade now. And the market might still not be conducive to your strategy. And one other thing you can do is, whilst that's going on, is downsize your position. Now, the negative to downsizing your position, again, it would be if all of a sudden your approach, your strategy, your method goes and has a number of winners, then you've been downsized, so you don't benefit from that. And so, but again, that's a very crude, naive way of thinking for a trader who says, oh yeah, but then you miss out on the wins. Yes, you do. But again, in the grand scheme of things, does it really matter if you miss out or you have a smaller position size on trades that do work out? Because all it does is it sets you up for mentally, at least you are still in a better frame of mind now. You started seeing it working again. It helps with your confidence levels, and so you're much better suited than actually carrying on trading at the same position size and just seeing loss after loss. Because, as I always say, professional traders look at how much money they can lose. Retail traders look at how much money they can make. So a retail trader is like, oh no, but yeah, you could make all this money. Yeah, I know. But think about it professionally. Why do you think some of the most famous hedge fund managers actually will say this? That they will downsize at times when things aren't going quite so well. They do it as well because they're out of sync with the market at that time, or their approach is out of sync, so they will downsize and then they will scale back. Once they feel back in sync with it, then they will scale back. So ignore the people that say you shouldn't do that, because that's nonsense. The reality of trading is we are risk managers. We have got to manage our risk. Even if that risk it means to you, you've got to manage that risk. You've got to manage and nurture your trading account. And so there will be times when you might just be better served just for a short period to downsize your positions for a while until you feel like you're back in sync with the market. Yes, it means that the models and your back tests, chuck all that in the bin. I really feel quite passionate about all of that, because people that say, oh no, you just trade your strategy, oh come on, this is the real world. So we have to have, it's great to have our strategies and back tests and all of that stuff, but you have to then apply that in the real world, and in the real world we got to manage our money as well. So that would be the advice that I would give you there with regards to trading through it. And lastly, I think that a lot of the time, this is tougher for new traders who haven't really been through drawdown phases or whatever, but if you have been through drawdowns in the past, let's get rid of this now. If you have been through drawdowns in the past in your equity curve, I always say bottle it. bottle that drawdown in your equity curve, because you're going to need that for the future. Put it in your little bottle here. Is that a bottle? I think I've got it upside down. So where's our little milk bottle? Maybe we've got a milk bottle like that. There we go. That's more like a bottle, isn't it? That's better. Bottle it. Bottle the memory of going through all of that. This is why it's good to journal, because when you journal your emotions. Not just, you don't just journal the trades, you journal your thought process at the time, how you were feeling as well. Because when you go back and review all that, that helps you in the future. So use your history as a resource going forwards into the future. I still do that to this day. When I'm having losing patches or patchy periods, we just feel a bit out of sync with the market, or the market's just a bit frustrating because it's chopping around. We have that history as our resource to say, oh yeah, we've been here before. Now, that's fine when you've got loads of experience, but when you have less experience, you don't have that to draw upon. If you've got a trader who's only been trading 6 months, they don't have that history of having traded through outer drawdowns historically. They may never have been through that, so that's harder for that person. That's why I put the video content out there that I do to show people, when I'm losing and winning and all the mindset stuff, so that people understand that everybody has this, everybody goes through it. It's just how you deal with it, which is most important. So the best thing you can do is have that as a resource. If you're a newer trader, you don't quite have that, but know and see it as something that is an experience builder. So when the market, and you feel like you're out of sync with the market, you're having a few rough days or a few rough weeks even, or longer than that, just remember that every trader out there has that as well. And if you can keep that in the back of your mind, you can then just look at your risk management, as I've already said. Tighten up, maybe trade a little bit less when you're going through those periods, and that will help you trade through and trade the other side. And once you come out of that drawdown, then that always puts you in a better position going forward in the future, because you've now got that tick in the box there as a future experience builder from which whenever it is in the future, to draw upon that whole period in the future, because I can guarantee this will happen to you again and again and again over the years. So get used to it and take the positives from it, the experiences, what you can learn from it, but appreciate it is going to happen again. But really, it's about how you deal with it. How do you deal with it, both mentally and from a risk management perspective? Anyway, hopefully there's some food for thought there for that question.